Hello, I'm Tom Zacharias with the National Crop Insurance Services, and we're here today to talk about agriculture, the role of risk in agriculture, and how that risk is managed. Agriculture is inherently risky. No one will argue that fact. Farmers deal with things that most small businesses don't. Farmers face many challenges, many risks in their operations. They face the risk of Mother Nature in terms of uncertain weather conditions. They face droughts, they face floods, they face uncertain markets due to, say, international conditions, changing international markets, input costs, rising fuel prices, rising equipment costs, etc. Why is this important to us? Well, farmers grow the food we eat, and it's the old adage, if you eat, you're involved in agriculture. How do we manage these risks? There's a role for government in this process. If there's a large-scale disaster, say floods like in 1993 or major drought in 2012 or 1998, all right, this would have large-scale consequences for many acres and many farmers over the country. America used to handle agricultural risk through unbudgeted, after-the-fact, ad hoc disaster bills. All this was taxpayer funded, very costly, also very slow to deliver. It could take 1 to 3 years. Starting in about 1994, after the 1993 flood, there was the Crop Insurance Reform Act. And this starts the basis of where we are and where we are going. There was a response to this large-scale catastrophic event, and that's the advent of the current-day crop insurance program. Then in 2001, crop insurance began to rise in prominence as farmers' top risk management tool, and overall federal agricultural spending started to trend down. The idea here was to reduce taxpayer burden and put the system on a planned, sustained basis. Under the crop insurance program, farmers buy insurance from a licensed agent, and then when a disaster strikes, flood, drought, whatever, a loss adjuster comes out, verifies the claim. Sometimes in less than 30 days, indemnities are paid. All right. A benefit to the crop insurance plan is that farmers share in the cost. They pay a portion of the premium. And in 2012, for example, farmers paid about $4 billion for about 1.2 million policies. And thank goodness they did. Why is this important? In the U.S., we have a safe, affordable food supply. Crop insurance helps underpin the infrastructure that allows us to enjoy that. Crop insurance was credited with keeping the rural economy afloat. According to one recent study, crop insurance saved 22,000 jobs and $2.2 billion in Iowa, Nebraska, South Dakota, and Wyoming alone after the 2012 drought. This was an enormous benefit. As we saw the drought sweep through the nation in June and July, indemnity payments were within 10 to 30 days paid to these farmers. Money went back into the rural community. And an important part from the aspect of farm policy is there was no call for ad hoc disaster. The insurance process was fast and fair. Checks often arrived within 30 days of a claim being finalized, and because of farmer-paid premiums and heavy losses shouldered by private insurers, taxpayers weren't on the hook for the whole thing. And best of all, farmers were able to access the capital they needed to get back in the field to produce what everyone hopes is a bountiful crop in 2013.